Hi, I'm Doug Carroll. Welcome to Introduction to Mortgage-Backed Securities. This module is intended to provide a brief overview of the mortgage-backed securities market. The bulk of the session will focus on the types of securities traded there and the mortgage loans used to create those securities. An important element of that discussion will be the features of the underlying mortgage contracts and how they impact the investment characteristics of the related securities. Let me begin with a preview of what will be covered during the course of the session. We'll start with a brief discussion of the basics of mortgages and mortgage-backed securities to familiarize you with the structure of the instruments, basic concepts, and terminology. Building on that foundation, the bulk of the session will focus on the most common type of mortgage-backed security traded in the U.S., agency pass-through securities. The first part of the main segment will entail an overview of the mortgage agencies, Fannie Mae, Freddie Mac, and Ginnie Mae. That will be followed by an investigation of pass-through securities, which will detail their structure and cash flow characteristics. That segment will wrap up with a discussion of the investment characteristics of agency pass-throughs, with a special focus on the risks that are unique to mortgage-backed securities. The final portion of the session will provide a brief introduction to the other main type of mortgage-backed security, collateralized mortgage obligations, as well as the methods for trading mortgage-backed securities, in particular a style of trading unique to agency pass-through securities, Tba Trading. There are a variety of different types of mortgage-backed and related securities: pass-through securities, agency and non-agency CMOs, home equity loan securitizations. All share some common structural features. This diagram attempts to highlight those common elements. All the various mortgage-related investment vehicles involve a securitization of assets, where loans to a large number of borrowers have been acquired to create a loan pool. The loans are held in a special purpose vehicle. Units of interest in that special purpose vehicle have been sold to investors. As the borrowers whose loans have been pooled make payment, those payments are collected in the special purpose vehicle. In turn, the monies collected are distributed to investors. There are many variations in the specific structuring of the deals, especially with regard to the collateral and the distributions to investors. Many of those specific or unique characteristics will be discussed in context as we touch on some of the different types of mortgage-backed securities over the course of the session. To have a better appreciation of the mortgage-backed securities market, it might be helpful to have some sense of its size relative to the other major sectors of the U.S. fixed-income markets. You can see in the exhibit before you statistics on the U.S. fixed-income markets as of the end of the third quarter of 2014. The amounts are based on the market values of the outstanding securities in each sector. You can see that the mortgage-backed securities market is the second largest segment, smaller only than the U.S. Treasury sector. At that time, the mortgage-backed securities market was a little bit less than 3/4 of the size of the U.S. Treasury market. This represents a dramatic shift from just a few years previously. While historically the U.S. Treasury market had usually been the largest sector in the U.S. markets, the mortgage-backed securities market was actually the largest market sector from 1999 until 2010. Mortgage-backed issuance exceeded Treasury issuance for the first time in 1996. And, as hard to believe as it might seem today, the U.S. ran a budget surplus from 1997 to 2001. So the Treasury market was shrinking for a while as the mortgage-backed securities market was growing rapidly. The mortgage market peaked in 2008 a bit shy of $10 trillion, at which time it was nearly 80% larger than the U.S. Treasury market. Of course, since 2008, the mortgage-backed securities market has been shrinking, albeit gradually, while the U.S. Treasury market has been growing very rapidly. What's the difference between mortgage-backed securities and asset-backed securities? In truth, the two have many similarities. They are structurally similar to one another in that both entail asset securitization, pooling of assets in a special purpose vehicle, sale of interest to investors, collection and distribution of cash flows. There are also important differences. On balance, mortgage-backed securities are much longer lived than the most common type of asset-backed securities based on either auto loans or credit card receivables. And mortgage-backed securities have a significantly greater likelihood of being prepaid, ergo more prepayment risk. However, mortgage-backed securities and asset-backed securities are very similar. In fact, so similar that in most countries other than the U.S., mortgage-backed securities are simply considered another variation of asset-backed security. But in the U.S., mortgage-backed securities and asset-backed securities are considered different fixed-income asset classes. Why? Well, in the U.S., unlike most other countries, the vast majority of mortgage-backed securities are guaranteed either by the federal government, in the case of Ginnie Mae securities, or the issuing agency in the case of Fannie Mae or Freddie Mac securities. That government or agency guarantee causes mortgage-backed securities to be considered almost default risk-free. Having a solid grasp of the investment characteristics of mortgage-backed securities requires a degree of familiarity with the loans upon which the securities are based. So what's a mortgage? The word mortgage has two roots, mort and gage. Mort comes to us by way of Old English, presumably via Norman French, and while it has a number of meanings, death among them, in this context, mort means locked or frozen. The other root word, gage, comes to us by way of Old German and means pledge, so a mortgage loan is a locked or frozen pledge. Consider the implications. Mortgages are originated either to finance a property acquisition, a purchase money mortgage, which is diagrammed here, or to refinance an existing mortgage loan, a refi mortgage. Once mortgaged, there is an unbreakable link between the debt and the property. Naturally, the borrower, or mortgagor, is obligated to make payment of interest and principal as specified in the loan agreement. Additionally, the mortgage holder, the mortgagee, as the lender is known, has a legal interest in the property, referred to as a lien. The property owner can only sell the property with the approval of the lien holder, typically granted in return for a portion of the property sale proceeds being used to pay off the debt. The property owner cannot legally sell or otherwise transfer the property to anyone else without a release from the mortgage lien holder. Mortgage loans in the U.S. have another unique feature compared to other debt obligations. In the vast majority of states, mortgage loans are considered non-recourse debt. Non-recourse means that should the mortgagor default on the loan, the lender or mortgagee has no right to go after the other assets of the defaulting borrower to satisfy their claim, other than to repossess the pledged property. In other words, the lender has no recourse against any other assets of the borrower, no matter how wealthy the errant borrower. No matter how many other properties, valuable securities, or other assets the borrower might possess, the only recourse the lender has is to repossess the mortgaged property. The exhibit before you attempts to illustrate these issues. The diagrams are a reprise of the diagram from the preceding page with one addition. You'll note that by the homeowner, in addition to the silhouette of the house previously purchased, there's also a money bag to represent the homeowner's other assets. Aside from that, the diagrams are exactly the same, showing the homeowner with the obligation to make monthly mortgage payments to the mortgagor, and the mortgagor having a lien on the property. The bottom diagram illustrates the implication of the debt being non-recourse in the event the borrower defaults. The lender can seek remedy through a foreclosure on the loan, resulting in the ownership of the property shifting from the homeowner to the mortgage lender. Note that the foreclosure on the loan would result in a cancellation of the debt, as well as obviating the need for the homeowner to make any future payments. However, the former homeowner still possesses their other assets because the mortgage is non-recourse. The lender has no recourse against any other assets of the homeowner aside from repossession of the pledged property. Another issue that has become important in recent years as a result of significant declines in property values is underwater mortgages. The phrase underwater mortgage relates to mortgaged property where the estimated value of the property is less than the amount of debt still outstanding. For example, let's assume there is a mortgaged property with $400,000 of principal still outstanding, where the homeowner estimates the property value to be $350,000. Since the value of the property is less than the amount of the debt, the mortgage is said to be underwater. As an indication of the severity of the 2008 financial crisis, at the depths of the real estate market in 2010, nearly 1/4 of the mortgages on residential properties in the United States were underwater. An issue sometimes encountered in connection with underwater mortgages are short sales. The definition of a short sale is a sale of a mortgaged property for a price less than the amount of the outstanding debt. A short sale requires the mortgagee's approval. As the lien holder, the mortgagee has the right to claim the property sale proceeds up to the amount of the debt. A short sale results in the mortgagee receiving less money than is still owed on the debt. We'll use the loan amount and property value from the underwater mortgage example to illustrate a short sale. Assume the homeowner is able to sell the property for the estimated value of $350,000. As there is a $400,000 mortgage debt outstanding, the sale price is below the amount of the debt. The shortfall, the forgiven debt, is a phantom gain which is taxable. So even though the home seller would receive none of the sale proceeds, all of the sales proceeds would be given to the lender as the amount of the debt was greater than the sale price, there is still a negative consequence from the homeowner's perspective. The amount by which the debt exceeds the sale price will be treated as a taxable gain. Let's consider the confluence of several of the issues just discussed. Specifically, let's consider the interaction between the non-recourse nature of the debt with the existence of an underwater mortgage. Naturally, if one has an underwater mortgage, given the debt is non-recourse, the property owner has some incentive to default on the loan. Using the numbers from the previous example, why do you want to pay off a $400,000 debt to become the owner free and clear of an asset that's only worth $350,000? It may be that it is the underwater mortgagor's best option to continue making timely payments on the mortgage. That is often the case if it's their only or primary domicile, so there's no other home or apartment to move into, and there is no desire or possibility of moving in with family or friends. However, if the property is a second home or a vacation home, or especially if it's a property held as an investment, the borrower has very strong incentive simply to give up the property in exchange for cancellation of the debt. There are a number of ways of categorizing mortgage loans. Commonly, they are categorized based on the type of property being financed, the interest rate payable on the loan, or the way the principal is returned. From a property usage perspective, mortgages will be designated either as residential mortgages or commercial mortgages. Residential can be further subdivided into single-family residences and multifamily dwellings, though somewhat confusingly, the industry standard definition of a single-family residence is a property that holds 1 to 4 families. Multifamily dwellings are for structures that hold more than 4 families. Commercial mortgages are usually characterized by the type of commercial activity taking place. Office building mortgages, hotel mortgages, warehouse mortgages, etc., to give but a few examples. The vast majority of mortgage-backed securities are based on pools of single-family residential mortgages. The majority of mortgage loans over most time periods have an interest rate that is constant over the life of the loan. These are known as fixed-rate mortgages. Some mortgages have rates that reset at designated frequencies. They're called adjustable rate mortgages, or ARMs. Most mortgage loans require payment of principal over time. In other words, they are usually amortizing loans. The most common type is a fully amortizing level payment mortgage. That means the mortgage contract specifies equal dollar payments each period, part of which is interest due on the outstanding principal, part return of principal. The split between interest and principal varies over time, but by the time the last of those equal monthly payments have been made, assuming no prepayments or late payments, not only would all of the interest have been paid, but all of the principal would have fully amortized, in other words, fully paid back. There are also loans known as balloon loans. In a balloon mortgage, there will be a level payment due for some number of periods according to the mortgage contract. But in the final period, there's a significantly larger payment. All of the still outstanding principal balloons, that is, comes due at that time. There are even some mortgage loans that require no return of principal prior to the ultimate maturity. The only payments required in all the earlier payment periods are for the interest due on the outstanding principal. These are known as interest-only mortgages, as that is all the mortgagor is required to pay prior to the final payment. Let's consider more closely the cash flows on the different types of mortgage loans with the aid of some visuals. In the diagrams on this page, vertical bars will be used to indicate the dollar amount of the monthly payments due under the terms of the mortgage contracts. The inset in the upper right-hand corner of this exhibit shows how to distinguish between principal, which is shaded in blue, and interest, which is unshaded. First, let's consider level payment fully amortizing mortgage loans. As was described previously, each of the scheduled monthly payments is for the same dollar amount. Each vertical bar is of exactly the same height. But note how the shaded portion changes over time. In the early years of a fully amortizing mortgage, the majority of money paid is going toward interest owed on the outstanding principal. Only a small portion is left to pay down principal. As time passes and the outstanding principal declines, the amount of interest due declines as well, so more and more money is gradually allocated to paying down the principal. Balloon mortgages will have two significant time elements, a balloon date and an amortization schedule. This diagram assumes a 5-year balloon mortgage that has a 30-year amortization schedule. If the balloon mortgage was for the same dollar amount, same interest rate, and same amortization period as the fixed rate level payment mortgage above, all the monthly payments prior to the balloon date would be for the same dollar amount on both loans. That is, the vertical height and shading of the bars over the first 4 years and 11 months would be identical for the two. The next and final payment on the balloon mortgage would be for a vastly greater dollar amount, as all the remaining principal comes due at that time. The final diagram is of an interest-only loan. The name here is very descriptive. The only payments the mortgagor owes prior to maturity is the interest due on the outstanding principal. That's indicated by the lack of shading in any of the vertical bars prior to the final payment. So if there are no prepayments and it's a fixed rate loan, as the amount of outstanding principal is the same, the interest owed each month would be exactly the same. At the loan's maturity, all of the principal comes due along with the final interest payment. The vast majority of U.S. mortgage-backed securities are known as agency securities, securitizations done by or on behalf of one of the U.S. mortgage agencies. There are 3 such agencies: the Government National Mortgage Association, the Federal National Mortgage Association, and the Federal Home Loan Mortgage Corporation, or as they are more commonly known, respectively, Ginnie Mae, Fannie Mae, and Freddie Mac. Note the quotation marks around the word agencies. That's because, if we're being precise, not all of the so-called agencies are truly agencies of the U.S. government. Technically speaking, only Ginnie Mae is a government agency. Fannie Mae and Freddie Mac are government-sponsored enterprises, which means they are privately owned corporations formed under federal law as opposed to the more common state incorporation. Although at present that private ownership is something of a technicality, since as of the time of this recording in early 2015, Fannie Mae and Freddie Mac are operating under a U.S. government conservatorship. That conservatorship was put in place in the aftermath of the financial crisis in the late fall of 2008. There is still a board of directors, but unlike the typical corporation, this board of directors is not elected by the shareholders, rather it's appointed by the U.S. Treasury under the terms of the conservatorship. Unlike the traditional board of directors that is obligated to oversee management to try to maximize shareholder value, this board of directors is responsible for minimizing potential costs to the U.S. Treasury. The future ownership structure of Fannie Mae and Freddie Mac is very uncertain at this time. Beyond ownership status, the agency securitizations differ somewhat in terms of the types of loans they typically pool, as well as by the guarantor of the securities. Ginnie Mae securities can only be based on mortgages that were originated under one of the various government mortgage guarantee programs. Those mortgage programs were designed to make homeownership easier to achieve for target beneficiaries. The vast majority of Ginnie Mae securitizations are based on FHA, Federal Housing Administration loans, but also VA, Veterans Administration loans, and RDA, Rural Development Association loans. Mortgages originated under those various government loan programs can be included in Fannie Mae or Freddie Mac securitizations, but over time, the vast majority of mortgages securitized by Fannie and Freddie are conventional mortgages. A conventional mortgage is any mortgage originated outside of one of those government mortgage guarantee programs. All agency securities are guaranteed, although the provider of the guarantee differs. Ginnie Mae securities are guaranteed by the full faith and credit of the U.S. government. That's exactly the same guarantee that stands behind U.S. Treasury securities, and the market views them as equally creditworthy, though Ginnie Mae's are riskier in other ways. On the other hand, Fannie Mae and Freddie Mac self-guarantee. There is and was no legal requirement for the U.S. to stand behind Fannie and Freddie securities. Most market participants believe that were Fannie or Freddie to get into financial difficulties, the U.S. government would not let them default. So while the government has no legal obligation, the market expectation was always that if necessary, the U.S. government would bail out Fannie Mae and Freddie Mac. Obviously, given the path history followed, that's exactly what transpired in the aftermath of the financial crisis in 2008. Another important distinction to make when considering the U.S. mortgage market is between conforming and non-conforming mortgages. That is a reference to the agency underwriting guidelines. The word underwriting has a number of different meanings depending upon the context in which it's used. Regarding mortgage-backed securities, underwriting guidelines refers to the terms and conditions that mortgage loan contracts must comply with to be eligible for inclusion in an agency securitization. Non-conforming mortgages are mortgage contracts that in one or more of their provisions does not satisfy the agency underwriting guidelines. Only conforming mortgages can be in agency securitizations. Non-conforming mortgages can be securitized, but that would have to be in a non-agency securitization. The agency underwriting guidelines address many features. The presentation will address just a few of the more prominent ones: loan size, loan amount versus property value, borrower creditworthiness, and income documentation. The government wants its programs to be seen as primarily benefiting those needing more help, people in the lower to middle income classes. So there is a size limit which loans cannot exceed to be eligible for securitization in an agency pass-through security. The general maximum size is $417,000, although in high-cost metropolitan areas, the loans can be as large as $625,500. Certainly, many properties could not be financed with loans satisfying those guidelines. Any loan that is larger than that permitted in an agency securitization is known as a jumbo mortgage. Such loans can be securitized, but only in non-agency mortgage-backed securities. Another underwriting guideline is the maximum loan-to-value ratio. That ratio is computed by dividing the loan amount by the property value. The loan-to-value, or LTV ratio, is just a complicated way of expressing a minimum down payment requirement. This guideline has changed greatly over time. For many years, the maximum loan-to-value ratio was 80%, 20% minimum down payment. But for a variety of reasons, the government desires to expand the possibility of home ownership and has been increasing the allowable LTV ratio. Currently, the maximum loan-to-value ratio can be as high as 97%, only a 3% down payment required for those with qualifying credit scores. Borrower creditworthiness is addressed by another underwriting guideline. The agencies can only securitize prime mortgage loans, that is, loans made to the most creditworthy borrowers, those with an A credit rating. That is the highest possible credit rating for an individual. Naturally, not all individuals or families qualify for the highest credit rating. Many would be considered less creditworthy subprime borrowers. Subprime mortgage loans have been securitized in the past, though not by the agencies. Subprime mortgage securitizations were non-agency CMOs. Agency guidelines require that the borrower be able to document their income in specific ways, such as providing an employer W-2. There are many creditworthy borrowers that would not be in a position to document their income in that fashion. For instance, many self-employed professionals don't have an employer to issue W-2. When the borrower cannot provide proof of income via the means required by the agency underwriting guidelines, that's referred to as a no-doc loan. In other words, the income cannot be documented in a way consistent with the agency underwriting guidelines. Let's now consider pass-through securities in some detail, starting with their structuring, the asset securitization which has been referenced a number of times previously. The building blocks for any mortgage-backed security are the mortgages on individual properties. The cash flows from these mortgages fund the distributions to investors. The most common type of mortgage-backed securities are based on pools of residential mortgages. Mortgages are created or originated when someone borrows money to buy or hold property. The lenders hold the mortgage as evidence of the debt and gives them a lien on the property. Agency mortgage-backed securities are based on a large number of mortgages. The typical agency securitization would include many thousands of mortgages. This diagram tries to capture that by showing a number of mortgage loans being originated, some purchase money mortgages, as well as a refinancing mortgage. Until the 1970s, nearly all mortgages were held as interest-earning assets by the originating lender. Nowadays, the vast majority of eligible mortgages are securitized. This diagram shows the original lenders selling the mortgages previously originated to an agency or sponsor doing a securitization. Once the mortgage pool has been created, units of interest, pass-through securities, are sold to investors. In general, when acquiring mortgages for a residential mortgage-backed security, the goal is to create a homogeneous loan pool. Ideally, all of the mortgages in a given securitization will be as similar to one another as possible. All the loans in a typical agency mortgage pool are on the same type of property. We'll assume the securitization we are considering is comprised of loans against single-family residences. All of the mortgages will have the same original term. There are securitizations based on 30-year mortgages and securitizations based on 15-year mortgages, each based on mortgages having those original terms. You would not find both 15 and 30-year mortgages in the same agency securitization. All the loans in the pool will have the same or similar interest rates. In a Ginnie Mae 1 program, all of the mortgage loans will have exactly the same interest rate. For all other Ginnie Mae securitizations, as well as all Fannie Mae and Freddie Mac securitizations, the mortgage loans will have interest rates that fall within a specified range. The homogeneity of the mortgage pool makes projecting prepayments a little easier, as all the borrowers will face similar constraints and opportunities regarding the management of the debt. That's important because uncertainty about the rate at which the pool will prepay is perhaps the greatest risk in agency securities. Between the underwriting guidelines and the guarantees, the investors will almost certainly get back all of their principal, but investors can't know the rate at which the mortgage pool will prepay. It's important to have a clear understanding of the various interest rates encountered when working with mortgage-backed securities. Be sure to distinguish between the rates being paid by the mortgagors versus the rate received by investors. The two are not the same. The mortgagors are paying whatever interest rate was agreed with the lender at the origination of the mortgage. The investors are receiving the pass-through rate, which was set at the time of the securitization. Pass-through rates are analogous to bond coupon rates. Though investors don't receive all the interest paid by the borrower, it's the rate borrowers are paying on their loans compared to the current mortgage rate that is usually the primary determinant of changes in prepayment rates. Uncertainty about future prepayment rates, prepayment risk, is often the greatest risk faced by investors in agency pass-through securities. Investors will use changes in current mortgage rates to estimate changes in prepayment rates. Insight into the rates being paid on loans in the mortgage pool is given by the weighted average coupon, referred to as the WAC. As the acronym implies, that is the average interest rate on the loans in the pool, weighted by the size of the individual loans as a percent of the entire pool. Not all of the interest paid by borrowers is distributed to the investors. The pass-through rate has that name because the rate expresses the amount of interest being passed through to investors. Some of the interest paid by the borrowers is used to meet various fees and expenses. Unlike a traditional term bond, the interest rate is payable on a declining principal amount as the underlying mortgages amortize. In addition to receiving the pass-through rate on the outstanding principal each period, the investors will also receive their share of principal paid back by the investors in that period. The expected future cash flows are usually one of the primary factors in valuing fixed income securities. Estimating the future cash flows to investors in mortgage-backed securities is particularly complicated compared to most other debt instruments. Let's consider how the structure of a pass-through impacts those cash flows by following the money. We'll track the cash flows from payment by the mortgagors whose loans have been securitized all the way through to distribution to the investors. To begin with, all that's showing in this diagram are the different parties involved. On the far left-hand side are the mortgagors whose loans have been securitized. On the far right-hand side are the investors holding the pass-through securities. Standing between the investors and the mortgagors are the servicers and the special purpose vehicle which holds the mortgages. To get a deeper insight into the cash flows paid out to investors, it's helpful to have a sense of how the cash flows are shared by investors in the same securitization. To facilitate that understanding, this example assumes two investors have bought the entirety of the pool, Investor A having a 60% interest, Investor B a 40% interest. Here I am not using market convention for expressing the size of an investment in mortgage-backed securities. Market convention is to express investment in MBS by an original face amount and a factor that quantifies the percent of the original face amount still outstanding. However, using percentages allows us to avoid some messy details and focus on the main concepts. The ultimate source of cash flows to the investors are the payments made by the borrowers on their loans. The mortgagors are obligated to make payments specified under the terms of the mortgage contract. Understand that the typical mortgage payment is for a larger dollar amount than the principal and interest due on the loan. There's often additional amounts due to cover real estate taxes and/or possibly a credit life insurance premium. While one or both of those factors can result in larger amounts being due from the borrowers, they will not impact the cash flows to the investors. They are noted here only to provide a fuller understanding of the situation. The only monies available for distribution to the investors are the principal and interest on the loans. Payments by the borrowers are made to the mortgage servicers. In most cases, at least initially, the loan servicing will be done by the originating lender, although that loan servicing contract might later be sold to another servicer. After the servicer receives payment, they'll direct any real estate taxes or credit life premiums to the appropriate parties and send principal and interest less a servicing fee to the special purpose vehicle. The servicing fee is usually 25 basis points or 0.25%. The special purpose vehicle, for which pass-through securities is normally a guarantor trust, will collect the principal and interest from the servicers of all the securitized mortgages. After the collection, the monies will be distributed to investors. All investors in a pass-through security receive a strict pro rata share of each and every dollar distributed. All the principal collected, whether paid on time or prepaid, will be paid out to investors in exact accordance with their percent participation. Since investor A has a 60% interest, they will receive 60% of all principal collected, whether paid on time or prepaid. As investor B has a 40% interest, they will receive 40% of all the principal collected, again, whether paid on time or prepaid. Each investor will get the same portion of interest payments as they are earning the same pass-through rate on their proportionate share of the outstanding principal. This diagram illustrates the scheduled payments on a 4.8%, $400,000, 30-year fully amortizing fixed-rate level payment mortgage. It's analogous to one of the bar diagrams encountered earlier in the session. The vertical axis shows dollar amounts, the horizontal axis time. If split into 360 vertical slices, each representing a monthly payment on the 30-year loan, the vertical distance from the horizontal axis to the top boundary of the shaded in area would represent the interest portion of each month's payment. The vertical distance from the top boundary of the shaded area to the ceiling would represent the principal portion of each month's payment. As was discussed previously, in the earlier years of the amortization schedule, the majority of each payment is for interest due on the outstanding principal. Only a small portion of the monthly payment remains to reduce outstanding principal. Even in the middle years of the mortgage amortization schedule, interest owed on the outstanding principal accounts for a majority of each month's payment. It's only in the final years of the life of the mortgage that most of the scheduled payment would go towards amortizing principal. What if there were a pool of 1,000 mortgages having exactly the same terms as the individual contract just discussed? What about the cash flow diagram on a pool of 1,000 such mortgages? The diagram for the mortgage pool would have the exact same profile given the assumed contract terms. However, as this is the scheduled payments on a pool of 1,000 mortgage loans, the dollar values on the vertical axis would be much larger. The scheduled monthly payments on a pool of 1,000 such mortgages would be $2,098,851.42. But what's the likelihood that cash flows to the investors would reflect this rate of prepayment by the borrowers? Remember, this is a diagram of the scheduled payments. In other words, these cash flows imply a zero prepayment rate. Unsurprisingly, the probability of a zero prepayment rate on a pool of 1,000 mortgages is approximately zero. There would certainly be some level of prepayments. The diagram of scheduled mortgage payments gives us no insight into the likely cash flows on mortgage-backed securities. Analysis of mortgage-backed securities requires investors to estimate future prepayment rates. Using the average prepayment rate of the last few decades results in a dramatically different pattern of future cash flows. That's not to imply that assuming the long-run average prepayment rate would be appropriate. Prepayment rates can vary over time and even from one month to the next. How long would it take for investors in a securitization of 30-year mortgages to get back half of their original principal? On average, over the past few decades, that would typically have been between 7 and 12 years. However, in periods of rising rates, that could stretch out to 13 to 15 or more years. In some periods experiencing big declines in rates, it has been less than 2 years. A detailed look at prepayment models is beyond the scope of this introduction, but let's consider the major factors that impact prepayment rates. Why do mortgages prepay? A variety of factors will influence the rate at which a pool of mortgages will prepay. A major driver is home sales, or housing stock turnover in industry jargon. Conventional mortgages have a due-on-sale clause, so as soon as a homeowner sells a property, they are obligated to pay off any still outstanding principal. Another factor, which at times accounts for a majority of prepayment rate changes, is mortgage refinancing. The level of refinancing is most sensitive to the rates being paid by mortgagors on existing loans compared to the rate at which mortgage lenders would originate new mortgages currently. Naturally, if the current mortgage rates are below the rates on existing loans, mortgagors have some incentive to borrow at the new lower rate and use the proceeds to pay off the existing loan taken out previously when rates were higher. While housing stock turnover and mortgage refinancings are usually the two most important factors, many other factors will impact the rate at which mortgages prepay. There is a strong correlation between the age of a loan, or seasoning in industry parlance, and the rate at which mortgages prepay. Newly originated loans are extremely unlikely to experience any significant level of prepayments. The older the loan is, the higher the probability of prepayments. Another factor is the ability of individuals and families to buy property. So consumer wealth or income would have to be considered when estimating housing stock turnover's impact on prepayments. In a strong economy with incomes rising or consumer wealth up, the demand for housing tends to rise. As a consequence, the turnover in the housing stock increases, mortgages prepay more rapidly, and as a result, principal is returned to investors more rapidly. The effects are all reversed in periods of stagnant income or declining household wealth. Housing is not as affordable, so the turnover in the housing stock slows down, prepayments occur at a lower rate. Not unrelated to the wealth and income issues just discussed, but exerting other direct impacts, is the general economic environment. In a strong economy with low unemployment rates, the loss of a job doesn't necessarily pose as huge a problem. Another job will likely be found quickly. Families are more willing to take on mortgage debt in such an environment, leading to higher housing stock turnover. Weak economic environments have the opposite consequences. Even population demographics need to be considered. With a younger and/or more rapidly growing population, there tends to be higher demand for housing, more turnover, more rapid prepayment. Conversely, for an older or static population, other things equal, we're likely to see much lower housing stock turnover rates. What about the risks of agency pass-through securities? Let's focus on the risks that are either unique to or are particularly salient with regard to understanding the investment characteristics of agency pass-through securities. First, credit risk. Credit risk is inconsequential when evaluating agency pass-throughs. That's due to both the agency underwriting guidelines that require loans satisfy certain standards, and perhaps even more importantly, the guarantees. Ginnie Mae securities are guaranteed by the full faith and credit of the U.S. government. Fannie Mae and Freddie Mac securities are backed by the issuing agency. Reinvestment risk is of greater concern with mortgage-backed securities than it is with equivalent maturity Treasury securities. Mortgage-backed securities will have more reinvestment risk for a number of reasons. First, they will have higher coupons, so there's more interest to reinvest at unknown future interest rates. Second, mortgage-backed securities pay more frequently. Whereas Treasuries pay coupons only semi-annually, mortgages make payment on a monthly basis. And those monthly payments would include not only the interest owed, there's also some return of principal each period. And beyond any scheduled amortization of principal, there's also the potential for prepayment of principal. Since a much greater portion of the total cash flows are paid out prior to maturity on mortgage backs versus Treasuries, reinvestment income will have a bigger impact on the rate of return over the time to maturity for mortgage-backed securities. Even more important than the impact on reinvestment risk, potential prepayments cause mortgage-backed securities to have an uncertain average life. Treasury securities have fixed cash flows because there are no embedded options. The uncertain average life of mortgage-backed securities results from the mortgagors having the right to repay principal more rapidly than reflected in the mortgage amortization schedule. That right to prepay means the mortgagor owns a call option on the mortgage. Without addressing option theory in any great detail, that call option gives the mortgagor the right to buy back the loan by simply repaying the outstanding principal. The inability to forecast when and or if mortgagors will exercise their right to prepay is why investors in mortgage-backed securities bear prepayment risk. Or saying the same thing another way, mortgage-backed securities have an uncertain average life. While it's impossible to know what the average life of a mortgage-backed security will be, one thing that is known is that the average life is likely to change, and change in the wrong direction from the investor's perspective. That's because the mortgagor is the one who has the option to prepay. The mortgagor is likely to exercise that option or not, depending upon what's in their best interest. And whatever is optimal for the borrower is likely adverse to the interest of the investors. Let's look more closely at the interaction between prepayment risk and reinvestment risk, and how the interplay between those two will work out to the investor's disadvantage no matter which way interest rates change. We'll follow the chain of causality. Starting with a change in interest rates, first, what would be the investor's preference regarding prepayment rates? Then, what's the likely impact on prepayment decisions by mortgagors, and in turn, how that will impact average lives of mortgage-backed securities? And ultimately, what are the consequences for investors? First, consider rising interest rates. Naturally, if rates go up, investors would like to get more of their money back sooner out of the older investments made at lower interest rates to reinvest those funds at the new higher rates. In other words, investors would prefer a shorter average life in a rising interest rate environment. However, the likely impact of rising rates is a slowdown in prepayment rates. Remember, it's the mortgagor that has the option to prepay. Unsurprisingly, if rates go up, mortgages taken out previously at lower interest rates now represent relatively attractive financing. So mortgagors are likely to prepay more slowly. In other words, exactly when investors are hoping to get more of their money back sooner, borrowers are likely to prepay at lower rates, resulting in longer average lives. Investors will probably receive less money than they had previously anticipated as a result of the rate rise, therefore less money to reinvest at those higher interest rates. What happens when rates decline? Pretty much all of the effects are the reverse of the rising rate scenario. From the investor's perspective, they'd like to leave as much money as possible in the investment earning the old higher interest rate. So when rates decline, investors hope for longer average lives. But again, it's the borrower that's in control, and it's their choice to prepay or not. If rates fall, there's likely to be an increase in prepayments. If rates decline enough, holders of old higher rate mortgages will be incented to borrow at the new lower interest rate and use the proceeds to prepay the old loan. That is a refinance, resulting in shorter average lives. Investors will end up receiving more of their money to reinvest at these lower interest rates. By way of example, in the spring of 2003, mortgage rates fell by more than 150 basis points, more than 1.5% in just a 6-week period. Unsurprisingly, that meant many mortgagors that had taken out loans either in late '02 or early '03 were facing a huge refinancing opportunity. An investor unfamiliar with prepayment risk that had bought a newly originated 30-year mortgage securitization in late '02 or early '03 might have assumed that it would be 12 or 15 or 17 years before they had received back half of their original principal. That would be a reasonable estimate in a stable or rising interest rate environment. But when rates decline so dramatically, prepayments will accelerate. In fact, in that time period, because of the dramatic decline in interest rates, there were some securitizations done in late '02 or early '03 where investors got back more than 50% of their principal within a year of the securitization. That meant not only were the investors not earning the old higher rate of interest on the securities purchased sometime in the previous year, this flood of returned principal forced them to reinvest a significantly larger amount of money in the much lower interest rate environment. The price behavior of mortgage-backed securities in response to a decline in interest rates can differ radically from that of similar lived Treasury securities. Mortgage-backed, like other callable securities, exhibit negative convexity. The price behavior of Treasuries and non-callable securities more generally exhibit positive convexity. If you're not familiar with duration and convexity, the jargon can sound technical and daunting, so let's demystify it a little bit. On the exhibit before you are diagrams that illustrate the price response to yield changes for both pass-through securities and non-callable bonds. The graphs have price on the vertical axes and yield on the horizontal axes. The curvilinear functions on each graph reflect how price changes in response to changes in the security's yield. From the diagrams, it's clear the two types of securities are characterized by distinctly different price behavior. Let's start with the left-hand diagram that reflects the price-yield trade-off on non-callable securities like treasuries. Non-callable securities exhibit positive convexity. Consider how prices of such securities react to an increase in yields. Given some price yield at which a security is trading at today, P star Y star, what is the price impact of an increase in yield? Naturally, if yields increase, bond prices decline. So what happens if yields rise again by the same number of basis points? Again, price falls, but note the price decline after the second yield increase is smaller than the price decline after the first yield increase. In a graphical sense, you can see that in the flattening of the slope of the price-yield function. As price is quantified on the vertical axis, the flatter the slope of the function, the less sensitive a bond's price is to a change in interest rates. Non-callable bond prices get less and less sensitive to interest rate changes the more yields rise. Naturally, as yields fall, prices increase. But for non-callable bond, prices are increasingly sensitive to yield changes the more rates fall. Each time yields drop by the same amount, each subsequent price increase is larger and larger. That pattern of price-yield trade-off is referred to as positive convexity because it generally works in favor of the investor. Yes, prices and yields move inversely versus one another. But as yields rise, holders of callable bonds are losing more and more slowly. When yields fall, their price gains are accelerating. The right-hand diagram illustrates negative convexity, which is exhibited by all callable securities. Though the nature of the embedded call option in pass-through securities is quite different and tremendously more complex than that in a callable corporate bond, the price behavior of pass-throughs is generally similar to other callable securities. Again, assume some price and yield at which a bond is trading at today, P star Y star. What's the consequence for a callable security's price if yields rise? Of course, as yields go up, prices decline. But note the price behavior if a security exhibits negative convexity. The price decline after the second yield increase is greater than the price decline after the first yield increase. For callable securities, as yields rise, price declines accelerate. Note the consequence of falling yields. Falling yields result in price appreciation. But as yields fall by equal increments, there is less and less price appreciation. That diminished appreciation versus what is experienced by non-callable securities is a result of the embedded call option. If a security is callable, or as in the case of mortgage pass-through securities, where each of the individual mortgages is prepayable at the mortgagor's option, that option for early retirement places an effective ceiling on potential appreciation. That cap on how much securities are likely to appreciate is the cause of negative convexity. Implications? As yields rise, pass-through prices become increasingly sensitive to yield changes. As yields fall, prices become less and less sensitive to yield changes. Aside from pass-through securities, the other major type of mortgage-backed securities are CMOs, or more formally, collateralized mortgage obligations. There are both agency and non-agency CMOs. As the agency CMO market is significantly larger, that will be the focus here. CMOs are pay-through securities. Let's make a clear distinction between pay-through securities versus the pass-through securities discussed previously. In both cases, all the money collected from the underlying mortgage pool, above and beyond fees and expenses, will be paid out to investors. In pass-through securities, as discussed earlier, all the monies are paid out on a strict pro rata or proportional basis. In pay-through securities, such as CMOs, all the monies will be paid out to investors, but unlike pass-through securities, it will not be distributed on a strict proportional basis. Rather, The money will be distributed according to some pre-specified priority. A number of different classes of bonds, known as tranches, have been issued in a single CMO offering. Investors in the different tranches will be receiving or earning some interest. However, unlike pass-through securities where each investor in the same security gets the same interest rate, the same pass-through rate, investors in different tranches of the same CMO may be earning different rates of interest. Also, unlike pass-through securities, where each month all investors would receive their pro rata share of all the principal paid by the mortgagors, CMOs will generally direct all return of principal only to one or several designated tranches until they are retired. Only after the tranches designated to receive their principal back first have received all of their principal can principal be paid out on the other tranches. Let's consider the most basic type of CMO structure possible, a CMO comprised entirely of sequential pay tranches. That name, sequential pay, is very descriptive. The principal will be returned in sequence to the different tranches. Here you see a diagram illustrating a CMO. The cash flows will ultimately be coming from mortgagors making payments on their loans. The structure of the underlying collateral is different on CMOs versus pass-through securities. I'll touch on the structure briefly later. Here let's focus on the way CMOs distribute cash to their investors. Assume a simple three-tranche CMO where all the tranches are sequential pay. Unlike the pass-through security diagrams we looked at previously, where all investors were receiving their proportionate share of both interest and principal, in the CMO structure, the investors in each of the three tranches are receiving interest payments. However, all return of principal is initially being directed only to tranche number 1, the shortest term tranche. Let's take the CMO introduced on the previous page, but put it into a longer time frame. On this exhibit, to begin with, we have the same diagram from the previous page. As indicated there, initially investors in all tranches are receiving interest, with return of principal being directed only to the shortest term tranche outstanding, tranche 1 initially. In this simplified structure, tranche 1 investors will be the only ones receiving principal distributions until all of their principal has been returned. Only after the last dollar of principal is returned to the investors in tranche 1, then and only then would the investors in tranche 2 start receiving return of principal. Note that in addition to any return of principal, the investors in tranche 2 would also still be receiving interest payments on the principal not yet returned. At this point, the investors in tranche 3 are getting interest on all of their principal, as none of their principal has been returned yet. Investors in tranche 1 are no longer receiving any distributions, as all of their principal has already been returned. Once the investors in tranche 2 have received the return of the last dollar of principal owed to them, then and only then would there be any return of principal to the investors in the third tranche, the final tranche, tranche number 3. So you can see why these would be called sequential pay tranches, because the principal is returned in sequence. Initially, all principal returned only to the shortest term outstanding tranche, tranche 1. Once that tranche has been retired in its entirety, then and only then do we start returning principal to the investors in tranche 2. And once the investors in tranche 2 have received back every last dollar of their principal, then and only then do we start returning principal to the investors in tranche 3. CMO structures are typically much more complex than the simple all sequential pay CMO from the previous example, although that one is very similar to the very first agency CMO issued in the early 1980s. A detailed discussion of tranche types is beyond the scope of this introduction, but a brief look at some of the variation might prove helpful for those new to the subject. Agency CMOs are structured on the basis of time tranching. Investors are not buying a particular maturity, but a spot in the queue to receive principal. Agency CMOs generally return principal in a sequential fashion, but the majority of tranches are not straight sequential pay tranches. There are numerous variations in tranche structure to create investments that have a range of different characteristics. Z-bond tranches, also known as accrual bonds, initially do not pay interest in cash. Until all earlier tranches are retired, the interest accrues. That is, the interest earned but not paid will be added to the face amount. This allows investors to avoid reinvestment risk until the accrual phase ends. PAC bond tranches are investments with more stable average lives than other types of tranches. PAC stands for Planned Amortization Class, and, as the name implies, there is an amortization schedule according to which the principal should be returned. That amortization schedule is not guaranteed. It depends on the actual prepayment of the underlying collateral. However, once in the amortization period, the PAC bond investors have the first claim on any principal distributions, even if that means setting aside the original tranche sequence. Where agency CMOs have a time-based prioritization for return of principal, non-agency CMOs return principal primarily on a seniority-based priority or credit tranching. The most senior tranche will be the one to receive most of the initial principal distributions. After the senior-most tranche principal has been returned in full, the next to receive principal would be the second most senior tranche, and so on. There is no agency or government guarantee on non-agency CMOs, so exposure to credit losses is an issue. One of the methods for insulating senior tranches from credit-related losses is to have some subordinated tranches built into the structure. Credit losses beyond other credit enhancements would result in a write-down of the principal amount of the subordinated tranches, but initially leave the senior tranches untouched by those credit losses. Just a few words on the collateral and source of cash flows to investors in agency CMOs. Aside from the differences in the way cash is distributed, the underlying structure of a CMO differs from that of a pass-through security. Ultimately, all money for distribution to CMO investors will be monies collected from mortgagors making payments on their securitized loans. However, in the typical agency CMO, the collateral is not the mortgage pool itself, but rather the collateral is pass-through securities that represent partial interest in pools of mortgages. Most agency CMOs will be based on multiple pass-through securities that represent partial interest in different pools of mortgages. The diagram reflects the purchase of pass-through securities from two different agency securitizations, one based on mortgage pool A, the other based on mortgage pool B. The monies available for distribution to investors in the CMO are the principal and interest collected on the collateral, the pass-through securities that were acquired to create the collateral pool for the CMO. Most trades in agency pass-through securities are done in a fashion quite different than the typical fixed income market transaction. In most bond trades, the buyer and seller are agreeing to trade a specific bond for an agreed-upon dollar amount. When mortgage-backed securities are traded in that fashion, it's referred to as specified trading. However, in most agency pass-through trades, the buyer and seller have only agreed on the general characteristics of the security. The buyer will not know the specific mortgage pool they are acquiring an interest in until shortly before trade settlement. That method of trading is known as Tba Trading, Tba being an abbreviation for to be announced. Specified trading is also sometimes simply referred to as spec trading. That's potentially confusing, as that phrase in other market segments would carry a different meaning. Outside of the mortgage-backed securities market, a spec trade is shorthand for a speculative trade, a position taken as a short-term market bet as opposed to a long-term investment. In the mortgage market, spec trading, or trading on a specified basis, means the buyer and seller have agreed to trade a specifically identified security, a pass-through security that represents a claim against a particular pool, or a specific tranche in a particular CMO. Sometimes agency pass-through securities are traded that way. CMOs, whether agency or non-agency, can only be traded on a specified basis. Trades done on a specified basis use corporate settlement, T+3. The buyer and seller will settle the trade, that is, exchange the cash for the securities, on the third business day after the trade date. Most trades in agency pass-through securities are done on a TBA basis, so called because the seller has not identified the specific pass-through at the time of the trade that's to be announced at a later date. Tba trading is sometimes referred to as generic trading because the buyer and seller are not trading based on the characteristics of a specific mortgage pool, but rather on the basis of the general characteristics of a subset of the mortgage market. All of the same agency's securities having the same pass-through rate are treated as interchangeable with one another because any one of them would be eligible for delivery on a TBA trade. Settlement conventions also differ for TBA trades. The buyer and seller agree on the month during which they'll settle the trade. The specific day is set by the Bond Market Association settlement calendar. The buyer and seller in a TBA trade would not have agreed on a specific pass-through security. In other words, a claim on the cash flows from a particular securitized mortgage pool. The buyer and seller have only agreed on a small number of the security's important general characteristics at the time of the trade. At a minimum, all the buyer and seller need agree on at the time of the trade are the agency whose securities are being traded, Fannie Mae, Freddie Mac, or Ginnie Mae, the pass-through rate on those securities, 4%, 4.5%, 5%, etc. The size of the trade expressed in terms of the amount of outstanding principal the holder of the securities would be entitled to receive over the time remaining to maturity, the price per dollar of unpaid principal, and the month the trade is to be settled. For instance, assume a buyer and seller have agreed to trade $50 million worth of Fannie Mae securities with a 4% pass-through rate for March settlement. The seller can deliver any Fannie Mae pass-through security having a 4% pass-through rate to satisfy their obligations under the terms of the trade. Issuing agency, pass-through rate, size, price, and month of settlement are the only terms upon which the buyer and seller have to agree at the time of a TBA trade. The buyer can request other special criteria to be included, but the majority of TBA trades have few special conditions beyond the 5 identified on this exhibit.